Hi there, it's Jill Underwood with another episode of The Voice of Mortgage Lending. Coming to you today from my big cozy chair. So come on in, have a seat next to me, and let's talk. I'm here to help you. Okay, so sit down. Today we're going to talk about self-employed people. When you are self-employed, it's a little bit different in how I calculate your income than if you are a salaried W-2 employee with a firm. Okay, so there's all kinds of different self-employed people. You could be as small as a sole proprietor where it's just you and you've got a Schedule C on your tax returns, or you could own a large corporation. Or you could own several companies. You could own 2 to 12 or 35 companies. So depending upon how complicated everything is, depends upon how I'm going to pull your income. Okay. I love working with self-employed people. I love pulling income from tax returns. There's something about me that's kind of a little bit unique. I love numbers and I'm kind of a geek when it comes to numbers. I can do like fast math in my head and algebraic equations in my head. It's very weird. So I really enjoy helping self-employed people because not every loan officer understands tax returns. They just don't. But I do. I love it because I've been self-employed. I understand what it takes to be self-employed. I understand what it takes to start a company and to keep a company running. I understand what it takes to have employees and to pay your employees. And there's a lot that goes into it. So if you're self-employed, just know these things. First of all, you need to have a 2-year track record. Okay, we can sometimes live with 18 months. But realistically, if you go back to one of my very first videos of the Voice of Mortgage Lending, when I talk about stability, well, the way that you know that your company is stable is if you've got a 2-year track record at least, and you're profitable. Okay, so if you've got 5 years of owning your company, it's going to be a little bit easier on the documentation that I'm going to need from you. But stable, at least 2 years is the number one thing that we're going to start with. And in addition to that, I really want to see 2 years of income tax returns. Okay, so if you're starting your brand new business, that's fine. Just don't buy a house yet. Okay, stay where you're at, get your company up and running, and be a good steward of the profits of your company. Okay, if you run a business that has a lot of cash, don't come to me later and say, now Jill, wink, wink, now you know I get paid a lot of cash that's not on that tax return. Okay, don't do that. Don't be that person, because guess what? If it's not on the tax return, it's not income. If you're not reporting to the feds and paying taxes on it, then why am I going to give you a loan that is ultimately going to be backed by the government or sold to a government entity on the secondary market? Yeah, the feds don't look too kindly on that. They just don't. They really want you to report your income and pay taxes on your income. It's just, hey man, it's a fact of life. We just have to do it. So, stability of your company, 2 years, reporting your income properly. Now, the next thing in the company is reporting your expenses properly. Because here's the deal. So let's just keep numbers easy. Let's just say that your company earned gross revenue of $100,000. Okay, great. Yay, way to go. But if you spent or wrote off expenses of $80,000 and your net income is $20,000, guess what? I'm pretty much going to use the $20,000. Now, there's some things I can add back, but overall, we're going to go off of your net. I don't get to just say, oh yeah, way to go, you made $100,000, because you spent 80 to make the 100. Does that make sense? So we have to be very careful, and we have a lot of calculations that we use to pull your income. So if you are planning to buy a house, you want to buy a house next year or the year after, and you're self-employed, when you do your tax returns, yeah, there's a lot of things you can write off, but you don't have to. Okay? It's a double-edged sword that I need income for you to qualify, but nobody wants to pay their taxes to the Fed. But you know what? You have to. We just have to. So you've just got to ride that line, do the right thing, pay the taxes on the income that you make so that I will be able to get you qualified to buy your home. Does that make sense? So self-employed people, stable, 2 years, reporting your income right, reporting your expenses right, so that I've got net income that I can use to qualify you, okay? In addition to that, okay, don't forget about credit. Credit is key. We really like those good credit scores. So anyway, that's it. Self-employed people, I love you. God love you. I've been self-employed. I've owned companies as well. I totally get it, and I love to help you. So thanks for tuning in. This has been Jill Underwood, that's me, and the voice of mortgage lending. So tune in next time. Take care and make it a fabulous day.